if I can really lean on my edge and have faith in my edge, then there is actually no stress in a day of trading. You back tested and tested 1,000 trades, and 1 to 2 is a good place to take a partial, but your data showing you 1 to 3 is better. It's a fact. Why are you going to get out on an impulsive decision if you know it's the wrong decision? In that example of, let's say, gym, if I wanted to get in better shape, I'll improve my body if I do this or if I do this. I'm going to see changes. But in trading, it's like you do these few things, you still lose money. You add on 10 more things, you still lose money. And you'll keep losing money until you reach an activation threshold, a tipping point where finally everything comes together. And the reason this is all important is because another trader will just be thinking, my mentor says, keep it simple. Don't overthink it. So when you ask someone that is consuming content of very simple technicals and someone claiming profitability, and you come listen to this podcast, you think, what are these nerds overthinking, overdoing? Like, it's not that deep. I hate to break it to people, it literally is that deep. Like, you have to take it to that extent because 95% of people fail. So if you're going to follow ordinary behavior, you're going to have an ordinary outcome, which is losing like everyone.
You mentioned your edge is your North Star, and your edge is constant refinement. It's not like, I have an edge now, I'm going to stop. It's good to share your thought process because someone out there is going through this exact phase. Yeah. So like, what is the next steps that you would like to take now?
Yeah, if I was to think, how can I squeeze out more profits at the end of the month? Yeah. There's always a...
Ladies and gentlemen, welcome back again to another episode. This time, as you can see, Waqar sat over here, and I am going to be the host this time. Welcome, bro, to another episode.
Welcome.
So last time we had an interesting conversation. We kind of diverted a lot from trading to your life, your psychology, your kind of way of maneuvering yourself through life. But one of the early things that I kind of noticed about you the first time I came across your journey was going from a hardcore swing trader, 1 to 100 risk reward, to a now intraday intercession trader. And I'm very fascinated by that transition. It's from the super, like from one extreme to the other, basically. And I wanted to maybe throw the ball at your court and see what you can reflect on that journey, basically.
Yeah, it's been an interesting transition. And again, I've been trading for almost 10 years. And I think it's pretty normal in 10 years of navigating anything for a lot of changes to come. The person I was at year one, the things I knew at year one obviously change. But obviously now with the podcast, obviously speaking to so many swing traders and so many fundamentals traders and also very scalp traders and pretty much the whole spectrum, that's also given me some more ammunition. But my position remains the same, that I think my way of trading, which is intrasession, serves me best because I don't have an edge when it comes to fundamentals or macros. I know the basics of economics. I took that to A-levels and that's about it. But I have no way to derive an edge. And even just, for example, we spoke to Andrea the other day.
Yes.
Who has a strong edge when it comes to fundamentals. It still seems like to time the markets is a challenge where you can know that inflation, taxes, interest rates all have these ramifications on an economy. Therefore, the health of the economy is good. Therefore, long term, it should be bullish for the next quarter, the next 6 months. But timing was still an issue. And even in his specific case, still leading to a 50% win rate. So when the famous spinning place analogy that I've given a million times, when I do factor all of these things in and I compare a swing approach to a intrasession scalp approach, when I look at win rates, they're about equivalent, and a win rate is something you can modulate anyway. How reserved you want to be, how it's something you can control. But your risk reward can be higher in a swing perspective because you are holding the trade for longer. But your risk reward of a trade is not only based on the duration of how long you hold it or how far you hold it. A novice mindset would be like, okay, if I catch 100 pips, I should get a high risk reward. True, but if you have a 50 pip stop loss, then it's just a 1 to 2, and you can get a 1 to 3 with a 5 pip stop loss in a session. So when I compare the risk reward, yield, trade frequency, all the metrics that I consider, there was no advantage in swing trading, but there were disadvantages that I personally found because I didn't have a fundamentals edge. When I'm swing trading with a technical edge only, with that, the psychology component is I've got to face heavy periods of price hanging around my entry.
Yes.
And for the ability for someone to not take an impulsive decision of like, it's not doing what I want. This is too much drawdown. I've been in 3 days in drawdown. All of these frustrations. It's very easy to make an emotional decision out of 3 days for a 5-second decision. So that impulsive behavior was a challenge for me. And another one was the ability to hold a trade and seeing it go into a 20%, 30%, 50% healthy normal retracement on a 4-hour time frame and not be affected by that dollar amount of 3,000 going to 1,000. Like that's a number that you will feel get eaten up. And I, as an individual, maybe I'm very inclined to I like quick feedback. I like to know very quickly if I'm right or wrong. I like to very quickly know if I'm going to hit my TP1 or TP2. I want to also know how quickly I can break even. That's a metric I almost the main priority I have in a trade is how fast I can break even. So when I looked at these things that are maybe shaping my personality, swing trading didn't serve me. And maybe the deal breaker for me of why swing trading was not optimal in my eyes was the risk to reward of holding a trade. Now you can look at a trade in terms of what it says on TradingView, which is risk to reward. So let's say you reference a 1 to 30 trade. A 1 to 30 trade on TradingView is not hard because you just have a 5 to 7 pip stop loss, which is a bread and butter stop loss range for me. But you can just hold that for a 4-hour market structure. So you're just holding that for a week and you're making a lower high to lower low on the 4-hour. Naturally, you'll get 100, 200 pips. So 1 to 30 is very doable. I'm not saying anything against that. It's just, is it worth doing that? It doesn't make any sense for me to hold a trade that is 1 to 20 in profit, assuming 1% risk. My account is 20% up and I don't take a partial. I don't think that makes sense because your significant amount of your account up and the risk reward of your unrealized P&L is significant. I'm risking 20% of unrealized profit to maybe gain another 10%. You have a negative risk reward of holding a trade, and that only becomes apparent if you're high risk reward swing trading. So when you do compare risk reward, which is let's say a vanity metric, you're just looking at a tool on TradingView, whereas what really counts is your ROI, your return on investment. So what did you risk and what did you actually get at the end of that based on your partials? And I think a smart swing system, if it is doing with a small stop loss, is going to be naturally partialing out, multiple partial levels. So then that final 1 to 30 level, if you're holding 10% volume, which is often my case, it's a symbolic position. The bulk of your volume was taken at the 1 to 5, the 1 to 10 or whatever. So the net ROI was not in your favor, whereas in a scalp or intra-session perspective, you can get that 1 to 3 and maybe even do a whole volume, and you can do that within 10, 15, 20 minutes and maybe do it again the next day or 3 days later. So with all these summaries, I think swing trading was not really serving me in any benefits, but it was more challenging to my psychology type. Another person would say, oh, but with scalping, you have so many things going on. There's more decisions to make per hour. So that is another challenge, but more catering for my personality.
There's multiple things here I'd like to dive deep into. One of them being, you mentioned it's not really working with your particular psychology, but then why did it appeal to you in the first place? Like, why was this the first chosen way of trading for, I think, maybe 3 years, was it?
Yeah, maybe even longer.
So why was that something that called to you, even though it kind of didn't fit your personality?
I think it's the thing that I mentioned earlier of like when you go through a journey of learning something, as time goes on, you change your mind about certain things, and everybody's journey in trading at least starts in a similar way. And that similar way is going to be the general things you learn online. And the most introductory things that people learn online is just market structure, support and resistance, Fibonacci, and these general terms. You're also kind of taught that lower time frame is noise, stay away from it, it's chaotic. Higher time frame, top-down analysis, these key terms are like, you're always safer on the higher time frame. So it just built a belief in my younger trader self of, if I want to be a better trader, I better trade the higher time frames. If I want to be more successful, higher time frames. Market structure is just 4-hour lower high to lower low. Higher time frame, daily, like all of these things is catering towards swing. And taking out the nuance, I'd say.
So do you think that's kind of the general consensus? It's kind of like the general idea about trading is like lower time frame is basically demonized. Would you say that is kind of the
maybe demonized is the correct word, because if you are comparing it to a retail perspective, the big guys online, the influencers and so forth, or even the rookie ones, I would say, like Baby Pips and all these intro places, they're all saying higher time frame is better. Higher time frame is not better. Higher time frame just holds more weight, but that doesn't mean it's more important. Let's say, if you can imagine it with me, if you have a daily lower high, lower low, and so therefore you have a daily supply zone that made the low, that daily supply zone obviously has a lot of weight, and you should be considering selling somewhere in the area in the daily supply zone. That's agreed. But what if price is here and the supply zone is up there for today and for the next day and for 3 days, 5 days, 1 week? That supply zone is not influencing you. So unless you're going to be a trader, like let's say a Burns that we've had on the show,
yes,
he doesn't trade one pair and try to master it. His approach is, I'm going to trade with a strong fundamental edge and see which currency pair or asset class, whether it's sugar, whether it's a metal, whatever, what's going to serve me. And then he's going to take a technical entry just off supply and demand. But the whole trade was not based on the technicals. It was based on the fundamental bias that he built. And the execution was on a very primitive supply zone, let's say. So when you are trading it like that, that makes sense. But if I'm trading 1 or 2 currency pairs and I want to master that, it makes no sense for me to wait for just daily supply zones, because that might be 20 opportunities a year as opposed to 2-3 a week. And my chosen way in trading is I don't want to trade 50 pairs and have my eyes on everything. I want to master one thing and master certain setup types. So it's different approaches. But the reason it is demonized because you're kind of told that higher time frame is the best way to be trading, and lower time frames is noise. So stay away from that because it'll confuse you and lead to too many losses. In principle, I get it. I can see where it comes from, because to a new trader, I would say the same. Just stick to the higher time frames because it has more weight and therefore less places to go wrong. But doesn't mean it's better objectively. And to be honest, a prime setup for me is obviously higher time frame aligned, but I also have intraday prime setups that are just as high quality, just as high win rate, just as high risk reward, everything that I want. ROI at the end the same, but it's got nothing to do with a daily time frame. It's got nothing to do with a daily point of interest. It might be in the no man's land of the daily time frame. So I don't think a higher time frame is conducive to a more quality setup. It's just for new traders. You want your training wheels when you're learning to ride a bike. It just gives you a better reference.
Maybe it's just easier to understand and explain as well.
Exactly. So I think a nice foundation, and I progressed away from it and realized I can stay there and be limited, and now I have to open up more currency pairs, or I can just try master one, which means I don't rely on just the higher time frame. I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
One thing you mentioned, which I feel like is also an excellent point, of when you're 1 to 20 up in risk reward, risking the extra 10% is a negative risk reward. Do you not think that the fundamental reason you've gotten into the trade should drive it all the way to your take profit level? For example, when you're entering on a lower time frame, right? Your first TP is 1 to 3. I can say the same thing about your 1-to-1 risk reward. You're risking from 1 to 3. You're risking.
I see your point. Yeah.
So you're kind of risking a bit of profit to making more profit, which is less than the actual profit you could potentially make. Yeah.
To be fair, anything after a 1 to 2 is a negative risk reward.
Exactly. So why are you now holding? Because the fundamental reason you entering the trade is based on, for example, the session volatility, which is X pips, 15 pips, whatever. So it makes sense if it gone this far to keep going. Yeah. Do you not think that applies also to swing?
It's a very good point. So if you are to take it from just a statistical perspective, a 1-to-1 is a great place to take a partial. A 1 to 2 is a great place to take a partial. A 1 to 3. Now, if you're not taking a partial, then you're foregoing 3% unrealized gain to maybe gain more. So it gets diminishing. So that is a great point. But you want to look at things from not just a data-only perspective, and maybe bringing other data like, okay, if I base a trade on a external, I'm going to call it major inducement, an inducement of a higher time frame supply zone. Price has done a run of liquidity of a daily time frame zone, and it's in the London Open. If I'm to look at 50 of those case studies, what is the initial reaction going to be on the M1 before a retracement? So let's say that move ends up being a 4-hour lower low. Not every case, but 1 or 2 of those will go all the way down to make a new trend. And that trend started from that major inducement. But how many of those led to an M1 push? Just an M1 reaction. And how large is that M1 reaction? When you factor in immediate impulses, you'll realize that if you are doing a 5-6 pip stop loss, a 5 pip reaction is actually selling yourself short, because that initial reaction on the M1 after an inducement in a volatile moment, in a volatile situation, hence a major inducement on the London Open, if you have correctly identified that initial reaction will be your average session volatility.
Yes.
And usually it's going to align with other things that people attribute it to. For example, you say, price targeted Asia low. There's no specific magnet on Asia low that price needs to go there that session. It might grab that liquidity the next day, or maybe it's not even important. So it's not the magnets of the liquidity pools people may see, or the trend line someone may see. It's not actually those things. It's the cause and effect. You've got some fuel. How far does that fuel take you? Meaning that you've got a bit of liquidity now. What's that immediate knee-jerk reaction? And that intra-session volatility or average session volatility on the EU is about 15-20 pips.
Yes.
So it makes sense, if you found a correct inducement at the correct time, to trade that initial reaction point as your first partial, which is why I don't take the 1 to 2 only and then look at diminishing returns of holding. It's more that this is the optimal place based on price action's nature, not just stats.
That sounds
alone.
good, but then wouldn't that also apply on a larger scale with the higher time frames?
So this is actually the decision I had myself of like, okay, I'm able to do a 1 to 30 trade in terms of like I can enter and I know where to exit. But there's a lot of things that go on in between and a lot of decisions that need to be made of what's the risk reward of holding. That is one decision we've touched on, but there's more decisions because let's base it on a 4 hour. I'm going from a 4 hour lower high to a 4 hour lower low, and I'm trading a bearish impulse on a higher time frame. And that's the premise of my final take profit level. Rarely is the case you're going to have a market structure where it's only showing you bearish, because on the 4 hour you see a bearish leg, but on the daily that might be part of a pullback coming into a lower time frame, higher time frame demand. So basically, when you do a multi-time frame analysis, you got a stack of daily saying one thing, weekly saying another, 4 hour being in a POI, M15 being another market structure, liquidity on M5. Like you have so many interfering ideas.
Yes.
And as a trader, your job is to make a decision with all of this information. And unless you wait for that perfect, every time from M1 to monthly is in a demand area and bullish, which is a once in a blue moon scenario, the average scenario in the market is not going to be so objective of, you have one take profit area and therefore hold the trade to that full duration. Let me put that into perspective. So let's say I'm entering on a 4 hour supply. My first reaction point of a reversal and the trade going against me could be Asia low, run of liquidity. Then it could be my M5 counter demand. Price went M5 bullish to my higher time frame supply zone. I'm looking to sell and break all demand areas. But that first M5 demand might be the first reaction. So you got Asia low, M5 demand, M15 demand. Maybe you got a support level. Maybe you got a counter trend line now. Maybe you got an EMA. Now you got a counter fib level. And when I was doing this as a younger trader, that's where my confusion came of like, okay, I have a trade. I know my final target is market structure says lower low. But all of these other things could say price has a reason to potentially reverse from here. How do I know which one to pick? And now I think most traders just pick. Like, oh, I'm going to pick the M5, but why not the M15? Why Asia low? Why this one? And there is no better reason or worse reason to pick one or the other. You just end up picking. And what usually people end up picking on is risk reward amount. I'm just going to take it out of 1 to 5. And that's going to be my static risk reward level of taking a partial. There's merit in that. Another one would be based on a reaction on one of these zones. So you don't just take the fib level. You come to the fib level and you wait for a doji or a rejection or a lower time frame something to say, I found a valid area you could reject and I'm seeing a rejection. Rejections can be misleading because it could just give a false reaction and continue lower in your direction. So that's not also an exact science. The last one is going to be emotion based. If you come to one of your levels, you know it's an active level, you haven't made a decision at the beginning, you haven't made a decision yet, and based on how your performance for the month has been, you'll make a decision in that moment. But if that same trade played in a winning period compared to a losing period, you will react differently. So you're going to be maybe more conservative of profit or let your losses run. And you don't want psychological influence. So I navigated all of these emotions and I realized that this is all vague. And when you have all of these vague approaches, you can't expect consistent outcomes, I think. You're going to be just, machine gunning ideas.
I would like to think that just like you have a data-driven edge saying that the average session volatility is 15 pips, therefore a 1 to 3 is reasonable. I would like to assume that there's the reason why you entered on a higher time frame. You should also have a similar range that, an average weekly range or a weekly whatever.
Right. I think a average session volatility or average session range is fairly consistent. Or let's say the standard deviations of a low volatility day to a high volatility day in a sample size of a month. That standard deviation is going to be 5 pips. 7 pips.
Would you say it's
so
more on
that degree of impact of getting it wrong is not massive. It's 5-10 pips. But then obviously it goes like this when you extrapolate it out to a average weekly volatility, because on average week you have a doji candle, and on average week you can also have a huge bullish candle.
Yes.
So the standard deviations of getting it wrong might be 20, 30, 50 pips. So then you're just and there's no way to get it right because it's just something that fans out like this.
Okay.
But you could also print out and say like what is the average pro trend impulse, and take data for that.
Exactly.
You could, and you're just going to end up with some sort of a bell curve, and you kind of pin it to that. And I'm pretty sure that's what a fib extension is, where you have your Fibonacci for the retracement, and the 61.8 is just the peak of the bell curve. And then when you have a Fibonacci retracement, you also have the projection of like where the TP levels, and those same Fibonacci projections are just that bell curve in general. And an EMA is another supporting point. So there are people that are utilizing that, but as you know, my philosophy is I don't really like to use correlation. I like to use a bit more causation of if I can understand why it's going to that fib extension, not just it tends to go to the fib extension. I don't like that ambiguity.
Fair enough, yeah. Okay.
I mean, and the last one is, if you have a fundamental edge, then that is the real way to get out of a swing position, because you're not timing it towards technicals or rejection points. You're timing it based on the polarity between two currency pairs based on macros has now come to a neutral standpoint. The market is agreeing at this point, and this actually aligns with the technical demand area now. This is now where the trade naturally concludes. And this is not something you can predetermine. You can predetermine a counter demand area, but you can also, with time, see how the macro narrative has changed and conclude a trade like that. So, and I think the great swing traders are doing basically that. They're just long-term holding until the macro sentiment changes, and then maybe using a very basic exit point on technicals. So the crypto markets are on fire and the bull run is well upon us. So instead of risking your hard-earned money, why not utilize other people's money? Well, as you know, the typical prop firm isn't really catered for crypto traders, and that's why I'm proud to introduce to you Bitfunded. And because they have partnered up with an exchange, you're not trading on a forex platform. It's as if you are trading on Binance. You get all of the benefits of traditional prop firms, but specialized for crypto. And most importantly, the special offer that I want to give you, they are giving away accounts. We're giving away 500 free evaluations. All you have to do is sign up. No payment required. So if you think you have what it takes to navigate the crypto markets, get started right away utilizing the link in the description to take you to Bitfunded's website and get 100% off your first evaluation, as long as you are one of the first 500 people. So do it right now.
You just reminded me, yes, Bern said exactly that he doesn't take his TP levels until the sentiment changes. And I think that maybe that is quite relevant when it comes to swing, to navigate in a way that is conducive for peace of mind.
I think a swing trader requires a fundamental edge, macro edge, to really master swing trading. Whereas to be a intraday trader, you can actually have no experience in fundamentals and just avoid news releases and still be okay.
I'm kind of impressed that you managed to be profitable swing trading without a macro edge.
To be honest, it was just a case of my approach in swing trading was not ordinary. I was not swing trading with a 50 pip stop loss. And to be honest, if I was swing trading with a 50 pip, 30 pip stop loss, like a typical swing trader would, yes, I don't know if I would have been profitable. My edge was the ability that I can pull out a 1 to 5 as opposed to a 1 to 3. At a time, and newcomers in the industry probably are not familiar, but if I rewind back to 2015,
yes,
the whole industry was different. ICT SMC was not even a thing. Like, no one spoke about it. So it was just very, very simple, head and shoulder, EMA, Fibonacci, and you were seen as like doing black magic if you did a 1 to 5. Like 1 to 1, 1 to 2, 1 to 3 was you're a great trader. You know how to 1 to 2, 1 to 3. 1 to 5 was like, no, it's fake. Like that was the sentiment. So when you come on and do showcase a 1 to 10, it's like, this is witchcraft. This is not ordinary. So obviously the industry has developed and shaped a lot since, but it was something that was not seen around, to kind of use an M1, M5 execution for a swing trade. And even when I look back, I wouldn't go back to that for the reasons I mentioned of what is your net ROI at the end, yes, and is it worth the extra headache to have the equivalent ROI when you can just use more volume on a lower time frame and then enter again. So that same swing move that I would have taken one entry and partialed out and eventually have no volume, I can enter 3 points on 3 valid setups, maybe not catch the whole move, but catch relevant portions of that move. And in the end of that same duration of 1 month, I got 3 entries, all giving me 3%. So I got 369%. Whereas in the swing perspective, maybe, yes, I got the 1 to 30, but my net gain was only 4%. So the ROI is what counts in the end, and the psychology too. 2
more points I'd like to touch on regarding technicals. So on the topic of risk to reward, I believe we briefly touched on the 1 to 3 and 1 to 10 approach that you now take with your intraday trading, and how more likely than not it would reverse after the 1 to 3, and that you would probably split test having more 100% at 1 to 3 and no runners on 1 to 10. Have you played around with that concept, or maybe considered refining it a bit and seeing how that kind of reflects on the data?
So yeah, for a bit more context, so this journey, this conversation is actually my journey of thought process over 5 years, which is when I have these sporadic levels and I don't know where to exit. And then there's approaches, as I just mentioned.
Yes.
Then when I've come down to a lower time frame priority approach, and I'm focused on intraday intrasession, I'm still carrying the baggage of decision making from the swing days. So I'm thinking, okay, I'm not really looking at daily lower low, but I'm still looking at M1, M5, and M15 structure, and then Asia low, equal low. Like I'm seeing, still on a day, I'm still seeing 10 points. I could take a partial. So what was I doing? I was changing it day to day based on my psychology, based on my performance lately, based on a feeling, based on market structure. Like, but there's no science in there. Yeah. So when you have a partial different every day, some days you nail it, and some days you get it horribly wrong, and you can kind of just say, well, that's the job of a trader, or what can you do about it? And that's why I hung around with that way for a long time, because I was just kind of in that false false comfort of, well, what can I do about it? But you can do a lot about it, which is I spent a lot of time and a very lengthy process of just going through a large sample of data and cleaning it and trying to find commonalities in there. It's a headache unless you have a tool or some sort of like software to help you. Manually doing it was a headache. And if I had something like exists in the marketplace now, like a TradeZeller, then well, you can just input your trades and get reports. So that's a lot easier. But I didn't have that when I was making these decisions. So it was literally sitting down, and even TradingView didn't do replay mode as far back as it does now. Now you can do replay mode pretty much as far back as you want if you have a pro account. But back then with the pro account on TradingView, I could only go back 30 days. Then I found a little bit of a loophole where I could go back 60 days when you double replay mode, which I don't even know if people know about. But then how can I backtest 1,000 trades or get data of 1,000 trades if I can't even go on M1 back then? Luckily, I screenshot every trade I ever took. So I just had I have a huge folder on my laptop where I've taken every screenshot of every trade I've taken, every analysis that I've done. But again, these were not clean markups. So, they're just screenshots in the moment. Sometimes each one is frame difference. My chart colors have changed over time. So it was a headache. It was a huge headache. But I went through and I said, okay, I'm going to go through all of these and mark out important KPIs and try and find meaningful data sets. And I came to the data sets first, and then I came to the explanation later. The data set that I found was, out of all of these trades that I've taken in the last few years, where is the profit places I took? And then I marked them out. And then what was the eventual outcome? So some of my trades pinpoint on my my exit, and then reversed. I smashed it. Just by chance I smashed it. Another day, I took a partial here, but price went all the way down here. I got it wrong, but I got profit. So when you do factor in where you took a decision and what was the eventual outcome, you can start to see, okay, if I in general added 10 pips to my take profit, I would be able to catch a little bit more. Some trades I would have missed. I wouldn't have reached my TP, but all of these trades, I would have got a little bit more out of it. So then you have to do a weighing up the pros and cons of, am I willing to forego profiting on a few trades to catch a bit more on other trades, and what does that look like in dollars? So it's a full analysis that I had to do. It took a long time. Long story short, I realized that for me to maximize my system based on my entry types in my entry zones based on volatility, so it's not going to be one size that fits all. The 1 to 3, 1 to 10 was the best place to take partials. I tested out 1 to 5 flat. I tested out 1 to 3, 1 to 12. I tested out 1 to 2, 1 to 10. Like I tested out all these variables and tried to spit out numbers for it on the dollar amount only, not a vanity amount of like how many trades actually reached and so forth. And the most optimal place for me was this. And I didn't question it for about 7-8 months. And then I just came to me on a call one day with some people and realized, where I've happened to put my 1 to 3 based on my entry type of a 3 to 7 pip stop loss. Well, if let's say my average stop loss is 4 pips and the average session volatility is 15 pips, well, my 1 to 3 is the session volatility. Exactly. And then my 1 to 10 exit, 3 pip, or let's say 4 pip stop loss, average day is 50 pips, and my 1 to 10 is 40 pips. Well, I've just found the daily range. So long story short, and that makes a lot of sense to me. Like the best place to take a partial is the average price reverses at a session and a day. Yes. So maybe I could have saved myself the whole headache and just come to that conclusion, but that was the conclusion. Now, this decision came to me a year and a half ago. And in fact, I shared it a lot online. A year and a half later, I'm still thinking, okay, how can I do that better? And looking at my performance over the last 18 months, it is true that not many trades hit my 1 to 10, but a lot of trades hit the 1 to 3.
Yes.
Yeah, a lot.
Yes.
So then it's a case of, does it make sense to just take full volume at 1 to 3 and forget the 1 to 10?
Yes.
Because if it was a 50-50, okay, then it makes sense to have both. They serve a purpose. But it wasn't a 50-50. It was maybe like a 70-30. So if only 30% of my winning trades are reaching the 1 to 10, maybe let's forego that and actually maximize more on the 1 to 3s. So there is some data analysis. I've been procrastinating on it because I have to go through all of that again. But there will be like a data point of, okay, it makes more sense to just fully take it, maybe not 1 to 3, maybe at the 1 to 4, maybe at the 1.25, I don't know. But more importantly is I want to get more creative with it, which is based on the entry type, how do I make a decision? For example, if I'm taking a trade based on a major inducement, an external liquidity run, I've got a lot of fuel, the chance of me going to 1 to 10 is higher. But if I'm taking an Asia low based M5 demand counter trend trade, the chance of hitting my 1 to 10 is probably lower. So now I need to go through all of my setup types and anchor that to an optimal profit type. And that's the work that needs to be done. But the pain point or the first identity is, I know that the 1 to 3, 1 to 10 is optimal compared to what I was doing before, but it's not optimal as a statement on its own. So for me to fully optimize it, I have to link it to other things, which is probably everyone should consider. Take profit based on the type of trade model that it is, and don't just have a blanket statement of I only do 1 to 3s and one whatever. It's based on pro trend, counter trend, liquidity type, and all these other factors, and that'll probably be the final evolution of profit management.
I feel like this is very useful for traders because, like you mentioned, your edge is your North Star, and your edge is constant refinement. It's not like I have an edge now, I'm going to stop. Edges kind of fade out with time, and it's very important now because you're in the phase of refining your edge a bit more, making it infinitely more sharper. It's good to share your thought process because someone out there is going through this exact phase. Yeah. So like, what is the next steps that you would like to take now?
I want to add to that point first is that the reason it's important to take this much, because another trader will just be sitting thinking, my mentor says, keep it simple. Trading is simple. Like, don't overthink it. And that is a big narrative in the industry. Like, you're overcomplicating. Like, you're thinking about it too much. And then you get some trading wizard online that is just doing a head and shoulder and showing that's the way to do it. So when you ask someone that is consuming content of very simple technicals and someone claiming profitability, and then you come listen to this podcast, you're thinking, what are these nerds overthinking, overdoing? Like, it's not that deep. That can be a narrative out there. I hate to break it to people, but it literally is that deep. Like, you have to take it to that extent because 90% of people fail, 95% of people fail. So if you're going to follow ordinary behavior, you're going to have an ordinary outcome, which is losing like everyone. So if you want to be in that 5% style of profit, you got to actually take it to all the way, because I'm not saying it's rocket science, but it's not easy.
It applies to everything, I think. It applies to like fitness, to business, to whatever. You can do the very eat less, move more, or you can really, really try to finalize, like optimize your health.
So in that example of like, let's say gym, if I wanted to get in better shape, if I just add in 10K steps a day, I'll see a change in my body. But if I wanted to go for an Arnold classic physique kind of thing, then I probably have to do a million other things.
Exactly.
So it's to the degree you want to achieve it. But in trading, there is not that leeway where I'll improve my body if I do this or if I do this. I'm going to see changes. But in trading, it's like you do these few things, you still lose money. You add on 10 more things, you still lose money. And you'll keep losing money until you reach a activation threshold, a tipping point where finally everything comes together. And the reason this is all important is because I've never sat down and had to address my psychology. And to be honest, every trader that I spoke to on the show, even though they may say like I do a lot for my psychology, reading between the lines, they don't actually do too much for their psychology. They do things that are good practices, like someone that is actively journaling as a something they do in their life, someone that is often meditating, therefore naturally more stoic, therefore naturally more calm, and therefore more collected in intense situations. These are all, I think, the cherry on top. It's just going to be making you well polished, but it's not the essence of someone's trading psychology. And I think what the essence of a lot of people's trading psychology, and for me absolutely, is the case that I had that true North Star. If I can really lean on my edge and have faith in my edge and really just put all my faith on the edge, then there is actually no stress in a day of trading, because and if you've actually sat and done that painful work of like, I know this is the best place for me to take a partial, even though it looks like it's reversing here, even though at this level I'm seeing a support level and I'm seeing a rejection on M1, I feel like I need to get out, and someone would take that decision and actually get out. But if you back tested and tested 1,000 trades and 1 to 2 is a good place to take a partial, but your data is showing you 1 to 3 is better, it's a fact. Over time, that's the best place to take it. Why are you going to get out on an impulsive decision if you know it's the wrong decision? And the reason people take bad psychological decisions is because they believe in the moment, through the heat and the environment of the stress of revenge trading or FOMO or whatever, they believe their irrational decision in that moment is the best decision, because that's the clarity they see. And then later on, when the emotions have gone, they look back and think, why did I do that? So the decision is influenced by the emotion, but they know that in this case and in that case, both felt right. So it's not about what feels right, it's what is right. And therefore, if you feel like doing this is the right thing, but your data is saying something else, you're not going to confuse it. And then a lot of these psychological issues will naturally dissipate, because you just know that my edge says this. So if my best behavior is to follow my edge, and if I deviate away from my edge, it's actually not in my favor. And it's easier said than done. But when you have spent hours and hours and seen it again and again, and it's just ingrained in your DNA that this is the best decision for me to make, you won't deviate away from it. And psychology slowly fades away as a problem. I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and NinjaTrader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader.
To circle back to the idea of the next steps that you might think about to now refine your edge a bit more, even though it could not be, like you mentioned, it doesn't have to be that complicated, etc. But then we're kind of trying to go from great to really, really good.
Yeah, if I was to think, how can I squeeze out more profits at the end of the month?
Yeah.
And if I was to make a roadmap from here, there is always a cost of trying to squeeze out more. And what are these costs? Number one is going to be mental capital. So how much more time and thought and effort do I need to apply to get more out of the market? And I believe that's a diminishing curve. Okay. So that's one consideration, or how much mental resources needed to get more profit. Number two is how much more time is needed, and is that time worth my time? And obviously from the outside, it can seem like, well, if you're making money off trading, then try and make more. But you reach a point where if you've made a few million from the market, you can make that million do other things. And then those other things require time. And I've reached a point a decade later where I have many things going on. So trading is not my only priority and not only my only source of income, and it's not the only reason for my livelihood. And I don't think it should be for someone that spent 10 years doing something. Naturally, you should diversify yourself, have multiple things coming in, active, passive, uncontrollable, which is the markets, and so things are guaranteed. Like that's wealth. Just making cash flow from the market is not wealth. Yes. So when I factor all of these things in, if I spend more hours on the chart, certainly I'll probably make more money at the end of the month. But I'm also going to neglect other things that are bringing me money. And if I'm looking at dollars only, maybe more time on the markets. But what about stability? What about these other things? Or let's say certain projects that are small now but have potential to then grow and then exit. These are all considerations. So it's not just a black and white case. So I'm factoring in time, I'm factoring in mental capital, and I'm factoring in just overall sanity. I don't want to put that as a separate one. The reason I say all these things, because for the best way for me to increase profit, and this is a mistake I see in a lot of people I speak to as traders, is they think, should I take this setup type? And I'm like, probably not, because you have, out of your checklist of 10, you have 3 boxes ticked. And even if it has a slightly, maybe a 50% win rate and a 1 to 3 risk reward, the data is maybe on your side, so why not take it? But and then I asked, in fact, there's a call I had with my community the other day. They were basically questioning like 5 or 6 trades in a row that I basically said, no, I wouldn't take that. And then they sat there and said, but these are the reasons that you could, and these are the reasons it would work out. And after a bit of back and forth of me saying, like, I see your point, it's worthwhile, but it's not really worthwhile, I just stopped and said, okay, what are you looking to achieve by taking these kinds of trades? And they didn't really have a response. They thought, this could be worth it. So I think you're looking to achieve more trade frequency. You're trying to get more trades out of the market. Mm-hmm. So if your goal is to get more trades out of the market, why is that? Because you want to increase your rate of return. Now, I'm going to remove the elements of because they want to get 10% to pass an FTMO. Therefore, they're chasing a target. That aside, increasing rate of return is a consideration. But it's not just like that, because if I want to just increase my rate of return, instead of me introducing less and less quality setups, that is also a diminishing return, because you can take A plus setup every time, an A setup every time, a B plus setup every time. But when you reach a 4 out of 10 setup, a 3 out of 10 setup, yes, they might have an element of a profit factor, but why not just take an A plus setup on another currency pair? So in my case, if I was looking to get more profit at the end of the month, right now I only trade EU and GU, and I only trade 2 hours of the day, 2 windows of the day. So I have 4 opportunities per day, and out of those 4 opportunities per day, therefore 20 a week, and on an average week, I'm executing 2 to 4 trades. So that's the ratio. If I want to have more than 2 to 4 trades a week, I'm going to introduce USD CAD. So I'll have Euro USD, GBP USD, and USD CAD. And now instead of me trying to force a C plus setup, a 5 out of 10 setup on my Euro USD, I'm going to take the A plus on Euro USD CAD. And that makes more sense to me. So that would be my biggest lever to pull to get more profit out of the market, is just look at another currency pair and look for A plus setups in that. Now, the cost of that is going to be, I'm going to have to look at 3 things with my 2 hour windows and open up that category. It's doable, but for me at this stage of my life, it doesn't make sense to do that in terms of extra commitments, because I think it's just gonna distract me, and I'm pretty content with my ability to pull out. In the last year, I pulled out 5% a month. If I'm to average it out, and I think that's sufficient, because I think a bigger lever to pull is capital. And now you can either try and get, instead of 5% a month, try and get 7% a month, or just try and get more capital into your account. Equally, at the end of the year, the dollar amount is what counts. So. In terms of next steps, what I'll look to do is, this question that I have right now to myself is my profit taking system optimal? Yes. Is it fully optimized? Not just yet. So I'm going to be taking partials based on a trade type. And if I wanted to actually get more out of the markets, I'll look to open up another asset class. And maybe the last thing I'll look to do is adding a swing approach to it, which means I'd have to get a grasp of fundamentals, get an edge in there, and know some of my intra-session based trades, allowing that to hold it to a swing with more than just symbolic volume. Based on fundamentals, but that's a long learning curve, I think.
It's interesting because you can also direct your attention and your effort to improve in different domains, not just refine my edge more. I can have the same edge, but introduce a new asset class. Same edge, but introduce X, Y, Z.
Exactly so.
It's good. It's good to consider these domains, because I didn't think of that when I asked any questions.
So the domains you have in general to consider is your psychology or psychology edge, your technicals, therefore technical edge, your account management, and therefore profit-taking edge, your risk management systems, and people can just do 1% risk standardized, but there is other ways to do it. Some people do fixed lot size, some people do percentage risk based, some people do scaling down risk when you're in a losing period, scaling up risk when you're there's martingale, like there's all these risk parameters. And the last one is fundamental edge. So if I, as a trader now, I think I've maximized 3, which is my risk systems are pretty good, my technicals are very good, and my trade management is pretty optimized. My fundamentals are, I'm going to say, basically 0. My psychology, 0. As a skill set, I don't have a strong psychology. I just have strength in others to not rely on my psychology. But if I wanted to get better as a trader, I'd probably have to focus on these 2 missing parts to be, let's say, optimized and well-rounded. An option, or just add in a USD CAD and continue to do what I'm doing in another asset class.
You've raised also a very excellent point of the cost of improvement. There is no cost of breaking even, but there is a cost of improvement sometimes, and one of them is sanity. I'd like to refer to it as just peace of mind, as you're doing the thing that you're meant to do. And that belief also reflects on life in general. So you're trying to improve in your job, improve in your health, improve in your whatever. Sometimes you're so obsessive that it harms your peace of mind and your mental health. How would you, for someone who doesn't have a million businesses going on and multiple things going on, how would someone be able to find that sweet spot of, this is worth my effort, worth my sacrifice at the moment, sleeping 2 hours a day, whatever, and now, okay, this is not worth my time, or this is worth my...
I don't want to sound like an old dog, because I'm not that old, but when you're doing something for 10 years, and I want people to actually think, what have they done in their life for 10 years? And if I look at my life, there's not too many things that I've done for 10 years consistently. Like people go, I'm not doing school anymore. I'm not doing university anymore. I'm not reading like I used to. Like a lot of things change. I used to play cricket a lot. Now I'm not doing that anymore. What have I done in my life for 10 years? Most people are sitting there thinking, not too much. Some people don't even have the same friends for 10 years. Yeah. So it's 10 years, an extremely long amount of time to do something. And what I want to say with this point is, when you reach a point of you're happy with where your system's at, you're getting out of the system what you want, you also have to think, why am I going to change it? And also, I'm so ingrained in this way of doing it, where my ability to trade is on autopilot. It doesn't require much effort. It's just, I know my rule sets, I know my data, and I just execute it, which is why I can travel and trade as you guys have seen me do. So it's just, maybe I'm stuck in my old ways. And like for me to now go back to the hustler mode that I had in my first, second, third year of trading, where I had to like deep back testing, deep journaling, deep studying, and trying to, that was exhausting days. And my life doesn't look like that anymore. So I know what it took to reach this level. And I know that if I want to now make major changes in my system, I'm going to have to go back to that headspace and do it all over again. And I think that's probably when you have, at my case, I was just a student. So I had no risk. My rent was paid for, my university tuition is paid for. So my job only is to pass my exams, and the rest of the time I want to figure out the markets. now I don't have the same level of carelessness. I got a lot of liabilities on my shoulders to pay for, so I can't now just go back against the wall and figure it out, because I have more to lose than I did then. I also have more commitments of time. I have to put my time towards other things, whereas back then I had more time flexibility. So when you are younger, in your early 20s, you got nothing to lose and everything to gain. So you can go all in. You can sacrifice your health, and I think that's fine for a short amount of time. You can sacrifice your sleep. I think that's fine for a short amount of time. Reason I say I think it's fine, because everyone that has achieved something significant often ended up doing things like that. And maybe it's not the most politically correct statement, but just look around and see who's done exceptional things and see how obsessed they were and how they sacrificed their social life, maybe even their family, to just be obsessed with a goal, and then the reward they reap afterwards. So for me, I think looking back, I'm not willing to hustle like that anymore in the same way. And I hustle with leverage, which is a topic we've had spoken about a lot. But for a young person, you got all the time in the world. You got time to reset. You got time to fail and do it again. Like that's the time. And I think it's harder to make it in your 50s, because if you got kids and a mortgage, how are you really gonna put yourself in an all-in position? But if you're 18 and you're going to school or university, just go all in and be obsessed with it, because those house parties and all those other things, you won't regret missing them.
Reading between the lines, the answer could be you should sacrifice as much as you don't have. Like, what you have to lose is less than what you have to gain. Once you cross that threshold of perhaps now you've got something.
But that's also, let's say, if you look at a mature investor, the mature investor that's a billionaire, he's already rich. So he's not trying to get rich with his investments. He's trying to just beat inflation and preserve his capital. So a very seasoned investor, his goal is just, if I can get 5% a year and I factor in inflation and I just pull out 1%, and that pays for my lifestyle and even more, why am I going to try and put my money into a meme coin and get 100x? But the guy that has a net worth of a grand, he really wants to put it into that meme coin, because he knows that 1K can turn into 10K, and that's meaningful money to him. And he knows if he loses that 1K, he'll make it again. But if that billionaire loses his whole billion and he's back to zero, that's a huge loss and not worth risking. So that's what investors do. A younger investor is more attracted towards gambling and crypto for the high returns, and a seasoned investor is more attracted towards stability. And they'll have a portion, 5% of their portfolio, to angel invest in startups, and that's their meme coin essentially. And I think that goes on with time as well. Like, you can go all in and be aggressive in your 20s, and your 30s a bit less, your 40s a bit less, and diminishing. And people forget the power of time. Like, it's better to be wealthy young, so be obsessed younger. I'd rather have the level of wealth I have now than in my 60s. I think you can do more with it, for family, for yourself, for experiences. You have the energy and time, and you also have time to fail. So you can actually be a bit more aggressive. So everything is catered towards doing things young. So why not go all in and lean on your family, lean on the ability to reset. And if you do something for 5 years, you will see a positive outcome. As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlation that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Do you think this kind of answers the debate of what is balance and how to actually balance your life? Maybe that could kind of be a good metric to
for sure, because balance is a misunderstood term, because I think people see balance as like, can I equally distribute my time with my family, friends, hobbies, money generating activities, and health, maybe other categories. And balance is, I can give each one of them appropriate time, sure. But that saying of jack of all trades, master of none, you don't excel in any of those things. You're not going to be the best father if you're so focused on, you're going to miss your high school, your kid's high school football game because you got a meeting to attend and work is pressing. That's not balance. That's lifelong equilibrium. But what about balance in terms of, why not go all in for 5 years to then have the rest of your life not so focused on money? So In fact, that's what you said. We spoke about last night. Of the goal is not money, because if you just have, well, you can explain it, of the constraint that you mentioned. I think you said it best.
Which part exactly are you referring to?
Just you're referring to like the people focus on the index of money and trying to collect so much in their bank accounts when it's more constraints and freedom.
I really love that. So the topic of KPIs and a goal in particular of like, okay, I am now trying to have this conversation with you to try to help as many traders as possible, right? A good metric to judge and gauge if we manage to achieve that goal is how many views this podcast would get. But then I am gonna, instead of focusing on that goal of influencing as many people and helping as many people, sometimes people focus on the KPI itself, of the views.
Yes.
And then I would do things that don't serve my goal, but serve my KPI. I could now pay someone $5,000 to watch the video. I gained 1 view, but didn't really help someone via this podcast. And similarly, people try to go for this money, whatever. I want to have this $5 million, I want to make $1 million, I want to make something. But now they focus on the money, but they forget why they're doing it. It's not really about having the money. It's about how you use the money. They made the KPI money. Exactly. They made the KPI the goal, and the KPI should never be the goal. The money should never be the goal. It's what you do with the money. And you should always look to have money to live a life of abundance, not a life of constraint. Because if you're living a life of constraint, not only are you not fulfilling your true mission as a man, to my belief, which is provide, protect, and provide not just for your family, but provide like help, be of use, be of utility to everyone, to your society. And if you're always living a life of constraint, you can't do that. How many people can you help effectively? How many people can you influence effectively? And money is just a KPI to judge your effectiveness as an individual in this day and age, basically.
Or let's say a metric towards potential abundance, but not abundance itself.
So the abundance itself is the goal. Freedom is the goal. Being able to be a person of influence, have deep reach in your society, that is the goal itself. Money is just one of the KPIs. And that's kind of why I feel like having a money goal is never really...
and it's that ability to choose where, let's say you want to live a life where you equally distribute it amongst those 5 things, you have the choice to do so.
Yes.
If you want to now have a period in life where you want to just be focused on the kids and give up on work for a bit, you have the ability to do so.
Yes.
Or your wife is pregnant, you want to take time off, you have the ability to do so. Money is going to unlock these things, and to have that real balance of I can choose when I want to focus on one thing over another. The balance comes from, unfortunately, money in this life.
Yes.
And therefore you need to maximize that when you can in your youth, so that you can have the ability to choose. And it's a false narrative that I can just clock out on my 9 to 5, and once that's done, I can focus on my family. Nice for the rest of your life, but then you also can't just disappear for 6 months or take a month off because your job won't let you. So that's actually not balanced. Then you're lifelong in a job.
One of the things that I've been playing with is the finite nature of time, obviously, but also of opportunity. For example, I can work 18-hour days for a limited amount of time in my life. I can do this sacrifice. I have only so many openings where this sacrifice is viable. And I can ditch that balance. And then after a specific threshold, I can no longer do that.
Yeah.
And I feel like so long as you can afford to do it, it's worth doing if you can gain more than you can lose. And that's kind of been my own litmus test.
For sure, I've said it online a lot of like, at this point in my life, I don't value time so much.
Yes.
Because I don't have kids. But surely when I have kids, I'll probably value my time freedom a lot more. So right now I use my disposable time to build more, and that can seem unbalanced or obsessive, or I focus on money too much. But then the fact that I focus on money so much means I don't need to care about money actually.
Yes.
And I'll throw it back to people that have a negative view towards money and say, they care about money more because they are thinking about the bill at a restaurant. They are thinking about, can I buy a pair of shoes? When if you don't care about money, it means you have an abundance where you don't think, you just pay the bill. You don't think, you just buy. That's abundance. And that's the real metric. And in the end becomes freedom. So maybe it's just a challenging thought for someone to think of, say, the life that I'm living right now as an individual, is this balanced? Yes, because I'm focusing on everything I want to focus on. But is that lifelong balance? Or are you just kind of in of a matrix?
A beautiful way also to look at balance is to just extend the time frame. Instead of trying to balance every day, so every day looks the same, let me try to balance over 10 years. And then instead of allocating X amount of hours on a daily basis to achieve this 10-year long balance, I can allocate years, like 2 years for this, 2 years for that, whatever. And along the 10 years, I am, quote, balanced. And I kind of also relieve some of the unnecessary stress on yourself when you're trying to achieve a particularly not ordinary goal. Therefore, you need a non-ordinary sacrifice. It just makes it even more difficult for you to do that. And stretching time always helps, I think.
I think it's also important to recognize that traders come in and they make their identity very quick, that I'm a trader.
Yeah.
And therefore, they kind of subscribe to something for the rest of their life and maybe don't think. Is it worth subscribing for the rest of your life? Is it worth being a trader even when you're 60? I don't know, it's just a question. But when I look around at successful traders that we've had on the show, pretty much all of them have other things going on. They have other ways of making money, and they're making money from the markets. And when the ones that are open about it, they very clearly show that it's not increasing year on year. It's not just that's more idealistic, but the reality is you can have a big year, then you have a low year, maybe even a losing year, and if you want to navigate that, and you need to have some other things to support you. And it's also very well documented with many conversations that you are likely to make more money in the market when you're not stressed about money, when you're doing the process, not thinking how much dollars I can make. So if you've got enough money coming in passively or through other projects to pay for everything you need to pay for, and then the markets is just a bonus, naturally you'll find more money in the markets. So I think it's very important that people consider from year 1, year 2, year 3, focus on the edge, focus on mastery of the skill. Year 4, year 5, year 6, focus on making as much money from the markets. As you approach year 10 and beyond, think, how can I use this capital and how can I have other streams to make income? Because probably, unless you are a master swing trader and you look at the markets, 1 hour a week, you can actually live a life with more income or the same income and probably put in less time than you would put into the markets. In my case, I have to show up every day to the markets, but certain investments I don't need to look at and they bring something to me. And that's wealth overall. And I think rich and wealth are different things. Rich is how much cash flow you have, and the markets will definitely unlock a lot of cash flow, but it's active work. Wealth is the ability to make money in a passive format and therefore not require your time or effort. And therefore wealth is going to be from your active income turned into passive income. And if the markets and other ways can make you as much active income as possible, put it into passive. The moment you've done that, you are now actually wealthy. And rich and wealthy are different things, and the market can definitely unlock both.
As we kind of deviated away from trading for a bit and now we're circling back nicely to it, I would like to link this to the statement you made earlier of 15 years ago, there was no ICT, there was no prop firms. Marketing, the market was very different. The traders were very different. And like you mentioned, 1 to 5 is unheard of. In today's age, in 2025, what do you think traders need to kind of maneuver in the ever-changing nature of the markets and their journey for the years ahead?
Yeah, so this is a big question. I think it has to come down to just core questions someone asks themselves, because without getting to just technicals and giving a strategy, I think it's the ability to just ask more questions to themselves and to people around them. And if they are thinking they believe something, just ask yourself, where is this belief coming from? If I believe this confluence in a strategy is adding, why do you feel that? Try and find some data behind it. So I think in this terrain, it's probably got harder and harder to navigate because there's more noise online and there's more people pulling for your time and attention and therefore dollars. That's from brokers to props to influencers. Like, there's all these things and they all seem great on face value. So a naive person can end up losing a lot of money to the industry and not actually to the markets. They just paid for too many signal services, paid for too many mentorships, paid for too many prop firms and blew it when they had no reason to be trading these prop firm accounts because they hadn't got an edge yet. If you never made 10% in your life before, why do you think you're going to make it on a prop firm account when it matters? So I think just being realistic and asking yourself the tough questions, and whether you can get people around you to hold you accountable, which I think is a hack, and I think that's probably the best way to do it, or at least to yourself, asking yourself these key questions of what's driving your behavior and beliefs. And as long as you're always staying in that curious state, you will less likely fall for the noise and the influence and the dreams. And as they say, if it's too good to be true, it probably is. I think that rings louder in this industry.
Do you think people should be trading for the entirety of the 20s, entirety of the 30s, until they make X amount, until they satisfy a specific need? Yeah,
it's a tough one, because to be honest, I feel like I'm in a unique position because I've spoken to more successful traders than, apart from Riz, probably any trader on earth. With this podcast, we've had almost 100 conversations with top traders, and I don't think many people have done that. And then I've also had communities where we've had thousands of people. I've helped thousands of people. I've heard the problems of thousands of traders, and obviously with the YouTube channel as well, intimately understanding people's behavior and thoughts and misconception in the industry. So taking all of that sample size of information, what I can understand is that unfortunately trading is not for everyone. And for me to put this, on the podcast, it's apparent for a viewer that each guest has a different level of articulation. And maybe their understanding is top notch, but the ability to explain it in an understandable, digestible way for a beginner, not everyone has that skill. And that's just one skill, communication.
Yes.
Everyone has a different ability to communicate, whether it's vocabulary based, whether it's tonality, entertainment based, whether that's just the accuracy in their words. That is a skill set in itself, and not everyone's born on the same level playing field, and not everyone's put the same time to develop it. I'm using this analogy to demonstrate the markets too. Not everyone, unfortunately, has the same IQ. And I've seen it that someone puts in more effort than another person, but the person that put in less effort found a more positive outcome just because they had a more aptitude towards it. They had a better grasp of things. Things click for them better. And I've seen it so many times where a trader's been putting in long hours and they've been doing it for months and basically made no progress. And another person let's not put names to it, but in the community, I've seen people that in the space of 6 months have got $1 million in funding, and it seemed effortless. And other people after 6 months are still asking very simplistic questions.
Yes.
And as bad as it sounds, like, humans don't have the same IQ. Humans don't have the same rate of learning. Intelligence, as a word, intelligence is not your ability to recall information. That's memory. That's not IQ. Intelligence is the speed at which you can change behavior.
Yes.
Or uptake new information. That level of IQ, but that's why you have IQ tests. And I know a person A and person B can learn the same things at different rates and therefore deploy it and actually get outcomes from it at different rates. So it's hard for me to say like everyone should be trading at 20s, because the reality is I've seen too many people fail for too long, and it's not because they lack work ethic. It's not cut out for everyone, because it's a hard thing to do. Just like when I was at university and I looked around at my classmates at dental school. I knew that you have the smart kids and you have the not smart kids, and the same kids are the ones struggling in their exams and the ones that ended up dropping out or got kicked out. And you have other kids that just studied a few nights before. I had one guy in my class who would literally study, just do an all-nighter before the exam, and he would get 90% every time. He's just one of those freaks that just recalls things better. That's the human population. So if you have that breadth of IQ, that breadth of learning in a population, trading can't be for everyone, because it's a skill set that's too intense and requires, unfortunately, a level of intelligence to make it, and it's not cut out for everyone.
Trading is difficult, but there's, like you mentioned, a subset of people where it's not, I wouldn't like to link it directly to IQ. I would like to direct it maybe to your specific cup of tea, like kind of like sports. Alex, your partner, gave a very, very good example to me just earlier. Some people, when they're just playing football, even though they could be very, very smart as an individual, they just don't have the coordination, for example, to play that specific sport. And just like aesthetics, arts, creatives, trading does require an eye for things, specific things.
Yes.
So I would like to link it to that. But then to follow up to that notion, it is difficult, but sometimes it is not for you. What is a good way to know when to quit and to know, okay, maybe this is just not for me?
Yeah, that becomes the challenging part, because I think it's good to be resilient. But let's say you've had good guidance. That's the big question. Like, have I had good guidance? Well, putting that question aside, if I'm being under the wing of someone who has a good strategy, who has proven profitability, and is someone worth learning from, and I've been with them for 1 year, 2 years, and I'm seeing no progress, then the source of the information is not the issue. That's a big assumption, but assuming that the source of the information is not the issue, and you've given it due time and effort, and you're seeing no progress after 2 years, that is I think a sufficient amount of time to know the aptitude is not there. The problem is you could spend 2 years and be with the wrong people and not actually give yourself the fair chance to actually assess, am I competent enough? Although I've made it sound a bit doom and gloom and tough, on the flip side, I do look at my trading now and my life now, and I do think trading is pretty easy, because I don't actually try and beat the market or think, how can I outsmart the market? I just have a system, and I know my system, and I just follow it. And at times I literally trade from my phone, which maybe sounds like, whoa, you trade from your phone and you don't have the big screens. But when you have a system and you know what you're looking for, you know what you're doing, and you know when and where and what's the execution points, it is fairly simple. So I guess there's both sides in this sentence, where it is extremely hard, but it's also, when you got it dialed in, it's very easy, because you're just making a few sensible decisions and executing on it, and those decisions are guided by data. So yeah, to be honest, I'm not fully sure how to give the answer of like when someone should know when to check out, but I think people maybe deep down know on themselves, like, have I given this a fair chance? Have I put correct effort in and time, and have I had correct guidance to then make a decision?
Do you think that inner meter is trustworthy?
I think giving yourself more and more time is always going to be in your favor. Like if you give up, what did you gain? Okay, nothing. But keep putting effort into it. But what I'm referring to here is the all-in effort. Like if you're all in on something for 2 years, and you're still seeing no results, your life is also not moving. But if you want to put in half in, so let's say I'm now looking at something else, building something else, and still involved in the markets after a 2-year point, so that you're not giving up on the markets itself, but you're also allowing something to come to your pockets, because making nothing for 2 years is not a realistic way to live.
I'd love to add the Jordan Peterson frame on trying. He is a big believer on, if you try to have something, you are more likely to have it. Like you're most likely going to have it. And it just becomes the definition of what does it mean to try. And the way he likes to frame it is, I think, is very profound. Of like, trying to do something means to try to vaguely define a path towards that thing, and then eliminate everything and anything that stands in that way that you do right now. So if I'd like to be in a better shape, let's vaguely define what it takes to be in better shape. And X, Y, Z, A, B, C habits don't really serve that purpose. And I'm going to ruthlessly, completely just eliminate them from my path. And to me, that is what really trying seems to be. And if you do that for an extended amount of time, either you're going to see results, or it's just not for you. And maybe that could be a good way to look at it. And just to kind of now wrap up with a more positive tone, we are in a privileged position to be very, very passionate about what we do. And we're very happy to be doing what we're doing. And for people out there who maybe not seizing this opportunity of trading, or on the fence, or half-assing it, I want you to maybe act as if I'm that person. I want you to tell me, why is this the really, really good opportunity, and why I should
this, let's say, harsh reality portion of the conversation is referencing a very specific metric for a successful trader, which is, are you able to deposit $100,000 of real money into an account and trade that account only for years? That's very hard, because you got to climb yourself out of the drawing periods. You got to climb yourself out of emotional portions in your life. One account and one equity curve over time, that's a real trader. That's very, very hard. But on the flip side of that, if I'm to say, here's 2 years of guidance, here's 10 grand, and here's prop firms, the ability for you to turn that 10 grand with prop firms and the correct amount of knowledge to 50 grand is very easy. I know that's going to sound maybe a bit blunt, but to be honest, it's very easy. If you've got 10 grand to deploy into prop firm challenges, you can afford so many chances to access $200,000, $500,000 of capital. You can fail a bunch of times and you're eating into your 10 grand, but if you have 10 grand and the average 100K account, I think it's probably 400, you got a bunch of shots to take. And for you to pass just 2 or 3 of them, you can be a very bad trader and just on law of probability pass 2 or 3. If you got a semblance of an edge, you can probably pass half of them. So you can very easily scale to $500,000 or $1 million in capital. I'm fast forwarding the timeline, but if you know what you're doing and you have $500 or $1 million in capital, and you know how to make 1 or 2% for 3 months, so a total 6% gain over the space of 3 months with $500,000 in capital, you've made more money than you've put in, and enough money to probably cover yourself for a year or 2. That's very easy, because you don't need to be a profitable trader. As a trader, you will have winning and losing periods, and then you look at the end of the year, what happens. If you are having ups and downs, and at the end of the year, it shows 0. No gain, no loss, 0. You probably had portions where from the lowest points to the highest point in your year, there's maybe 10% in there. If that 10% was timed correctly on a couple of accounts, and then you blew a couple of accounts here and there across the year, okay, you lost a grand, you lost 500, you lost another grand here, you burnt these accounts, but then that correct portion of your equity curve was timed on $500,000, you made 50 grand. You paid for your 10 grand in challenges, you pocket 40 grand, and that's you good for the year. That's very, very, very achievable. And that's the reason I encourage people to get into trading, and I think it's a correct vehicle, because there's no such leverage in life where the skill set to do that is you don't need to be a great trader. You need to maybe take 5 good trades. To take 5 good trades, you don't need to master your psychology. You don't need to have a great profit. You don't need everything we spoke about. You don't need it. You just need one profitable setup with one good risk management, good profit taking system, and capital. That's easy.
As a non-trader, I've been around a lot of traders for the past now 3 years, and I might be a bit like blunt in saying this, but it doesn't seem that difficult. I think the difficulty is kind of exaggerated. Would you agree to that claim?
The difficulty of taking winning trades is zero. Anyone take a winning trade. The difficulty is, exactly, the chicken analogy, or not analogy, it's a real chicken that's taking trades. The ability to take winning trades requires zero skill. The ability to take correct winning trades is hard. The ability to not take silly trades is hard. The ability to take valid losses and understanding it's a valid loss is hard. So the hard part is not on the winning trade side. The hard part is in all the mess. So if you take any trader that's watching the show, if they look back in their account history, if they add up all the winning trades, does that add up to 10%? Yes. Every single trader has had a few winning trades that add up to 10%. The reason they don't have 100 grand in their pocket is because they took another 50 losing trades that made them blow the account. So the problem is not in the winning trades. The problem is in the losing trades. And that's why the sentence of the main channel is a restricted trader is a profitable trader, because the profitability you seek is in the losses you avoid, not in the winning trades you take. And then it is easy, because if you realize the power of capital and the ability to just make 2% gain a month, super conservative, and you got a good capital there, maybe it's 3 trades a month and a 50% win rate and a positive risk reward, that's not hard. Like, you just got to not take 20 trades in a day and not mess it up, and like, that's the hard part. And restricted is profitable is a powerful statement that I hope people pay attention to.
As we wrap up this beautiful episode, I want to give you a chance to directly address the thousands of people that tune in weekly. What would you like to say to them?
I think I'd like to say thank you first. This show has grown a lot and has given us an ability to connect with amazing people and have amazing conversations on and off camera. And for what is done for my personal satisfaction and fulfillment in my career, to see the comments of people and see what kind of impact we're having and tangible benefit people are feeling from these conversations. I, as an individual, opening my mind to different things, different questions, different businesses, collaborating with certain guests on businesses, like it's opened up a whole world for me, and it wouldn't be possible for people tuning in. So I think it's wicked that we have a show that people, tens of thousands, hundreds of thousands of people sit and watch this room and watch a conversation. And if we look at the total impressions of people that have been looking through that lens at this fireplace, millions, and it is crazy to think about that, but I think it probably reflects the cool conversations we've had. And out of everyone that is involved in Titans, the team, the viewers, everyone, I'm the luckiest because I get to sit in the host seat and speak to today the other way around. But I get to ask questions that I want to ask, and I hope people like the questions. So I'm the one that's the most grateful here, because I'm the one that's gained the most. And my goal with the show moving forward is giving people as close of an experience as we can to be sitting in this seat. Obviously, we can't actually physically do it, but new projects that we're looking to launch is with that mission statement in mind of like, how can we get as many people sitting in a seat asking traders questions they want to ask and learning from traders, not just one or two, but as many as they can. And this is free. This conversation is free. So in a format that is pretty much free, that would be a cool statement. And until then, if people keep tuning in and keep learning, we're all winning together. And there's very few formats in life where it's a win-win-win. The guest wins because they get an opportunity to share their beliefs with many people. I win because I get to get a platform and ask questions to people I respect and learn from it. And the viewers win because they get to watch, hopefully, nice conversations to no expense of their own. It's a win-win-win format. And as it grows, well, I guess we all win together.
It's always a pleasure having these conversations with you, bro. And I hope the viewers also gained a bunch of valuable insights from it. And yeah, man, thank you for...
And how do we end the episode?
Boom.